All right, this is Ubaid on behalf of V Electronics, and in this video we're going to talk about the relationship between interest rates and present value. All right, so when it comes to interest rates, if you use a formula for present value, okay, as the interest rates go up in the market, okay, the cost of borrowing goes up, as a result of which the present value, let's say the present value of stocks, real estate, so on and so forth, okay, goes down. Okay, as the interest rates go down, okay, the cost of borrowing is less, as a result of which there's more demand. Okay, as a result of which, okay, the prices, okay, of real estate, okay, the prices for stocks, for example, etc., okay, these ones they go up. Okay, so you can conclude that interest rates are inversely proportional, okay, to present value. Okay, so interest rates are inversely proportional. This is inversely proportional to present value. All right. Now, okay, if you were to take an example over here, so let's say your present value equals future value divided by 1 plus I all raised to n. This is the formula for present value. Okay, this is the future value of your asset. I stands for interest, n is your term, number of years. Okay, so this will be, let's say 100, just for this example's sake, divided by 1 plus 0.05, all raised to 10. So if you were to do the math, okay, this will be 100 divided by 1.05, okay, all raised to 10. This comes around 61.39. Okay, so this is 61.39. Now, if you were to bump this interest rate up, let's say to 8%, okay, this will be, okay, same future value divided by 1.08, okay, all raised to 10, okay, $46. Okay, so this will comes $46. So we know that as the interest rates go up, okay, the present value of assets go down. Okay, and on the other side, okay, if we talk about the future value is directly proportional, okay, to interest rates. Okay, and this may have to do with, okay, the investor expectations. Okay, so the investors, okay, they do predict before investing as to what the prices of their real estate properties, their prices of their stocks will be in the future. Okay, which means that if the interest rates are expected to rise, okay, what's going to happen is the future value, okay, of that property, of that asset will rise as well, will go up. If the interest rates are expected to shrink, okay, the future value will shrink as well. Okay, so right over here, okay, you can conclude, you can make a conclusion, okay, that as, okay, the interest rates climb, okay, the future value goes up as well. All right, and as the interest rates go down, the future value will go down. So technically speaking, interest rates are directly proportional to future value. All right, and we can use an example over here. Okay, let's assume, okay, that your future value equals, okay, present value into 1 plus I all raised to n. Okay, so let's assume that this is 100 1 plus 0.05, all raised to n, let's say 10. Okay, so if you do the math, okay, this will be $100 divided by 1.05, all raised to, okay, this is 10 over here, so 61.39. Okay, this will be 61.39. Okay, this will be 61.39. All right, now this will be your future value. Okay, now if you were to change the interest rates, let's say the interest rates go up to 8%. Okay, so this will be 1 plus 0.08, all raised to 10. Okay, into 100. Okay, this becomes $216. Okay, so this is $216. Okay, so this will be your future value. All right, so we know that as the interest rates go up, okay, the future value goes up as well. Okay, as the interest rates go down, the future value goes down. All right, so that would be it for this video when it comes to the impact of interest rates on present and future value of assets. On behalf of V Electronics, this is Obaid. Have yourself a great day.